Welcome to the very first edition of the Real Estate Rundown. I'm Chris Hallows with Benchmark Mortgage.
And I'm Renee Gaun with Realty Executives of Flagstaff.
And Renee and I have started kicking this off in the sense of we realized that there's not a lot of great information. I mean, case in point here, guys. We were just as we were prepping this, Renee was looking at one site that she holds a lot of weight on. And since you've sent that out to clients before,
Yes.
And realized that it was, we don't know how.
Not as accurate as I would like it to be. And we pull everything directly from our MLS, and there's a million other different resources that people like to go through. And this is definitely the most accurate we discovered.
So there's so many layers, guys, of like what is happening in the real estate market. What is the data, right? We got it, and much less getting away from the emotion of happening, because there's so much emotions that go into a home purchase, even if it's still like a second home or investment versus first-time home buyer. And so our goal is that we are going to do a monthly show here to give you about 20 minutes, 25 minutes of accurate local, hyper-local data to help you make decisions.
Yeah, it's a full rundown of everything that we've seen occurring over the past couple weeks or even the past couple months, so that you can really feel like you have your finger on the pulse just like we do. I
love it. So without further ado, let's jump into the July edition here. Another warm summer in Flagstaff happening. Tons of road construction. Be careful on the 1740. We could do a whole episode on that. So let's dive into our first topic, though. You wanted to talk about, we have this fun label here of crash versus concessions, right?
Yes.
So we're talking about like a lot of people, especially in the fall, we're seeing these predictions of 30%, 50% reduction in price points. We're not seeing that, but we are seeing some give and take in the market. What are you seeing, Renee?
I'm seeing a lot more flexibility on sellers' ends. So I do have some clients that have been able to negotiate for concessions or largely reduce a purchase price. So unlike the last couple of years, we are seeing buyers be able to kind of pull out with a little bit more than they started out with. And it's a good feeling for sure.
And that's where people need to realize the value of that. I mean, obviously, let's go into some perspective. If they get a $10,000 reduction on price, right? That equates to, in current market, about $60 less a monthly payment. Right. So that's a win, right? We'll take it where we can get it. If they do $10,000 in a concession on closing costs, that then can be, with typical buyer closing costs kind of on the higher side right now. Yeah. Historically it was $5,000 to $8,000. Now it's kind of like $8,000 to $10,000-ish. Right. That can put dollar for dollar money back in that buyer's pocket to then either, keep that rainy day savings high, just reduce overall their cash to close, use that money to fix up the property with their intentions afterwards. I mean, that did not exist in the last 24 or 36 months.
It did not. And I have a lot of clients opting to keep that money in their pocket versus reduce that purchase price, because that $60 a month doesn't make a huge difference. But when they can keep $10,000 in their pocket to be able to do repairs or whatever they need to do after closing, it comes in handy.
Absolutely. And so that kind of plays right into our next topic, as we're talking about inflation and the Fed and what's happening there, because that money can be used as well to lower the rate. Although we're not necessarily seeing a lot of people wanting to do that, just because we do believe rates will come down. So, everyone, if you've watched any of our content before, we had a lot of predictions at the first of the year of hopefully seeing some really good inflation reports come out May through June was a lot of expert expectation, thinking that we could be as low as maybe mid fives by the summertime. We're not mid fives. Right. Right now, sitting here in July, we're looking about mid upper sixes, maybe dipping into low sevens, depending on cost and scenario there on a primary 30-year fix. What we're seeing, though, is we did see a very, very good CPI number last week. And so finally, that's kind of the number that a lot of folks were expecting in May. So we're just lagging, and that's exactly what inflation is. It's a lagging indicator as we assess the previous months. And full disclaimer to everyone on our data here is it's basically based on like June numbers, right?
Exactly.
And year to date is as of end June, typically. But yeah, last month's inflation that came out just a few days last week was seeing headline reduced from 4% to 3%, and the core inflation from 5.3 to 4.8. And one important thing that a lot of people need to understand is that is CPI. There's a couple different, I'm not, Google these definitions, not going to go into it right now, but that is one inflation measure of consumer price index. Another one, though, is that tends to move faster than CPI is PCE. And there's a really cool chart we'll have, or you guys are looking at it right now here, of seeing that PCE actually led CPI. So we could see way back when rates were still in the 2% range, we could see this inflation starting to take off really much faster with PCE than CPI, right? So the Fed was reacting off of CPI thinking things aren't that bad yet. In reality, they were getting really rough. And that's where we saw rates shoot up from the 2s to the 7s because we're so slow to get on top of that. But what you can see now in PCE is actually dipping very, right on track. And we're looking really, really good there. But CPI isn't showing that yet, so that's where we're still hearing the Fed, and that's where rates are still lagging, that we're still hearing the Fed be really concerned on inflation and still working, planning some potential rate hikes still, where in reality, if we're following PCE, that gives us that hope and that a lot of data to go behind that rates will be reducing, should be fairly soon, right? And so fairly soon, in the months to come, we should be seeing some relief there, but we'll still have to be a little patient.
Yes, and what we're seeing on my end is still a lack of inventory. So what makes that tough is we're actually down 19% from where we were last year, which is interesting because we're also still able to get buyers into more homes than we were last summer, but there's also significantly fewer buyers in this market due to interest rates. We are hoping to start to see that inventory climb, but we're just going to keep hanging in there with what we've got, and we'll see where it goes.
And specifically, I love the couple we were looking at that here together. A couple of stats on that to just give you context is this time last year, there was 1,000, or total listings year to date was 1,120, which is this year has been 907, right? So as far as month to month and what you're seeing out there on inventory, because I know people love those little online sites and there's a lot more available price points that you're seeing listed. And so you might think like, oh my gosh, it's getting saturated with inventory. Like we are, so relatively there speaking, as we're looking at that, is there are 289 active listings as of June, the end of June. And this time last year was 306.
Right.
So we're not seeing like all of a sudden tons of homes on the market.
We're not. And we're also not seeing pricing change drastically. Last year, the median sales price was $645, and we're actually looking at $695 now. So even though there's fewer buyers in the market, it's still competitive. We still don't have the inventory to support it. So you just have to come in knowing what to expect with those numbers as well.
And I know we talked about median and averages can be dangerous here.
Very.
So being careful on that because there's some outliers can skew the data, right?
Drastically.
But as far as I was going list to sold ratio there, which is then an average, right? So whether it's a $200,000, $250,000 condo, or I believe we had one home that sold over $5 million this year in the Flagstaff area, which again skews the data here. But we are currently sitting at 98.6%, right? So to help everyone understand that homes were selling at 98.6% of the original list price, which I think speaks to two sides of things, right? People are listing far more realistically than they maybe were 8 months ago. Right. But that they're getting pretty close to that ask price.
Almost every single time.
Yeah.
Yeah.
So a little bit give, like you said, there's some concessions.
Right.
But we're not seeing a 30% reduction.
Well, we're not. And we're also not seeing buyers come in with a $50,000 offer above asking price. So even though they're getting that list price, that's great for the sellers, and on the buyer's end, you're still not having to push so hard with waiving your terms, waiving appraisals, contingencies, and you're not having to come in as high to get your offer accepted.
So I have a little bit of question on that because anecdotal is you got to be careful with that, but I do know that still, and I don't know how much I'm seeing of it in current market, but I do. Well, actually, no. I had a client just last week. So here's the anecdotal aspect of it, talking about getting beat out by cash, having multiple offers. So that is still happening.
It is.
And can you help me understand the kind of context or what's your gut feel on why is that happening? Where is that happening? Yeah. Can I help people understand that? Because that's where a lot of people get scared of saying, oh, I don't want to enter the market because that's either happening or then other people are staring the other side of things. But yeah. Where are you seeing some of the faster paced or hotter action happening?
Well, so to go kind of back to the cash topic, so in the gated communities of Flagstaff, we're seeing about 35% of the homes are selling by cash. And across Flagstaff, if you take out those gated communities, we're still hovering around 30. So 30% of homes that are closing in Flagstaff are still closing.
I haven't heard that
cash.
one recently. That's crazy.
So it feels like a lot, but it's not the majority. And I think a lot of that has to do with the fact that because interest rates have shifted so much, a lot of people who had the money in pocket over the last couple of years, their saying was, why would I use this money? I can basically borrow money for free at a 3% interest rate, at a 2.5% interest rate. And so now that they can't utilize interest rates of that sort, they're going to utilize their cash.
Yeah, gotcha. I think too, when it's highly desirable, right? It's some of the times that we're seeing when it's like, hey, something doesn't pop up in that neighborhood, it's priced right, it backs Greenbelt, or it's really like, or we talked about certain homes even more recently that it's just when they're, certain unique or the architecture, different things that are highly desirable that they move. We've seen 7-figure homes moving same day.
Absolutely. And it still goes back to the inventory. I mean, if they're waiting for a home in the perfect area and they haven't seen anything and it's been months or weeks or whatever it is, and that home pops up, people are still going to be really aggressive to try to get that.
Yeah. And that, coming up to then our, my last topic here is, when the levee breaks, and people saying, okay, so a lot of people are waiting for something to happen, right? Mm-hmm. Which, again, hope is not a strategy, right? So we got to be careful there. But with folks needing to realize like what's gonna give, and something is gonna give, right? And so I don't. As far as all the data supports, everybody is we're already seeing when we look at month over month, appreciation. We did see values soften a little bit from let's see, I wish I had my data and my stats here. It was July of 2022 through January of 2023, and then we actually saw month over month nationally. We're seeing small appreciation. Mm-hmm. And so that's where I think to say all the data is supporting, just like you said, yes, there's overall less activity, but there's such less inventory out there that it's pacing with activity. When things got a little crazy, so many builders had lived through 06 and 08 mm-hmm. that they slowed their building down, mm-hmm. right? If all those builders just kept going full bore, we'd probably see new construction prices, or not probably, we would 100% see new construction prices come down, but we haven't.
Right.
Conspiracy theories aside, what do you want to say about builders or not? It's a capitalist country. They slowed their production to keep pace with, rates kind of steadying out and normalizing, going from the high 7.5s to kind of normalizing here to where basically what prices are likely not to give or in a significant way.
Right.
That's fair?
Oh, completely. I just don't see it happening anywhere in the near future.
So, but what is going to give is interest rates. And we don't have an exact crystal ball on what's going to happen there. But what I think it's important for folks to understand the impact here. So let's kind of go real quick. As far as an average loan amount here in Flagstaff is about $425,000 is an average loan amount. So working off of that $400,000, just to give folks some concept here or context here, is a 1% reduction in interest rate. It would mean about $260 less per month.
Right.
Okay. A 2% reduction is then, with mathematically working out, it's not exactly just addition, but it ends up being about $530 per month. Those are huge, right? And that works in a couple different ways here of, when folks are looking at this and really anyone looking at short term, right? Don't get in the market. Let's just say that, right? Because there could be so much ups and downs. This isn't for the faint of heart. If you think you're just going to be in Flagstaff for under 3 years, don't buy a home.
I would agree with that. You have to be very, very strategic. I think it's still possible.
Could work.
I think you have to know that that's your plan and you have to execute properly to not kind of regret things potentially in the next couple of years.
Yes, I'll agree with that. Very, very strategic, right? And there's that old adage of have you heard this one? You don't make money when you sell a home, you make money when you buy a home.
There you go.
Does that make sense?
Oh, yeah.
Because that person that buys that home, if they have that exit strategy in 3 years, and they buy that home at market price with everybody else, and everyone else appreciates, and it's just, it gets skewed if you're moving out of state or something, saying everyone else is moving at that same rate. Mm-hmm. So if you can get a concession and you get a price reduction and you bought at $15,000 under.
Right.
We actually just ran that chart. I think it was Client Years that we just ran a buy versus rent analysis. And it's like, well, if you bought $10,000 under market, you just made $10,000.
You're in the clear.
And now people understand, like, go talk to your financial advisor and ask him how to turn your money into an additional $10K in 3 years.
Right.
right? Especially with markets right now, that could be a tough question. But if you buy low, that's where that works.
Yeah.
But again, overall, traditionally speaking, you're especially more of your like first-time home buyer, folks that are not really here to play a market. So much of like saying the mid to long-term buyer, you are, much safer on all volatility kind of smooths out with time.
Yes.
And overall, in 10 years from now, because how many people do you have saying, "Oh, I wish I bought a home in 2010"? Everybody. But saying hindsight's 2020. So what will that home be worth in 2028 or 2032 or 2033? It seems crazy that we'll ever get there. So knowing, so what we'll give is interest rates are going to give. Are prices softer now than when rates are 1% to 2% lower? I would tend to think logic says yes, you have much more negotiating room than you will if we're talking about rates in the 5s and maybe even 4s.
Right.
Because we've talked about essentially interest rates need to get back to normal once we have this volatility behind us. We've talked about probably a 1% reduction. Why would we participate or project maybe a 2% reduction? And that's if interest rates follow every single time that the Fed has come off high inflation, which we head into a recession and interest rates actually dip.
Right.
And again, it's not 90% of the time, 95% of the time, it's 100% of the time. We've seen that in history. So if history accurately repeats itself, we could see up to a 2% reduction in interest rates. So again, thinking, all right, that $533 a month is now back in your pocket, Mr. and Mrs. Buyer, like congratulations. That does wonders for a budget, right? As well as, and we can talk about all the different things that does for budget. That also helps them potentially reach. If you say, hey, I'm okay paying that higher payment, so let's put that $533 back in the payment. That could be on that $400,000 purchase price, up to $80,000 to $100,000 more in qualifying power. So if you're really out, it's Flagstaff. If you're really not stoked on what you're seeing at like $350,000,
right?
But all of a sudden you give Renee a call and can say, hey, I'm looking at $450 now.
Yeah, it's a big difference.
Big difference.
And you really have to take into consideration how it's not going to be right away that you're going to see that payoff. It's going to take time, and that's okay for it to take time, but you just have to know that that's what you're getting into. And honestly, the other thing that you have to think about is when interest rates do go down, that's going to increase the amount of buyers that you're competing with. So you could wait it out, but you may not even land where you could have landed at that higher interest rate.
Because the buy and refinance strategy is definitely, that is a significant one, right? And so I think that's where a lot of folks understanding that I'm talking to a lot of people that are saying, hey, this is where I'd like to be budget-wise. And I tell them, that's great because you can qualify for that. It's just not going to get you the home you want, right? And so let's talk about you can push that budget. So a lot of people I'm talking to can actually push budget, but then put some probably upwards of $400 to $500 more than they'd really want to spend per month.
Right.
So that is, we're not telling you go do something crazy.
Definitely
we're not pushing
not.
You need to make decisions on your own with the data provided. But a lot of those folks might be able to say, hey, based on your personal belief and what we're seeing in markets, and also hedging your bet, right? As soon as you close on that home, I'd be saving every penny I could, just so if rates don't dip as much as I thought they would, that I can also pay down principal and get that payment where I need to be, right? But that's where I think there's a lot of strategy to be had. If don't go into the scary spot for your budget, but maybe push it a little bit. That buyer might be rewarded.
And you have to take into consideration as well, if you're in that lower price point, there's every chance that you're going to be looking at some significant repairs and or upgrades that you need to do on that home, which is money out of pocket anyways. So if you're increasing your budget, you're maybe able to get into a home that you're not going to have to put a lot of cash into after closing.
Yeah. So one other quick fact that I thought was crazy. So when the levee breaks, if that same buyer, so a $400,000 loan amount, a 2% reduction in interest rate, and they say, hey, I don't want to save the $533 a month and go buy tchotchkes or jet skis or whatever, but I want to pay down my mortgage.
Yes.
10 years cuts off the mortgage.
It's huge.
Right? Turns you into a 20-year mortgage. So yeah, again, we can't promise when these things will happen and say exactly when they'll happen. But I think that's the silver lining that folks can have some hope in, is that interest rates will be reducing. There will be better opportunity. And that just creates hopefully some relief, knowing that, no, we're not going to see 50% reduction in price points and a 2% interest rate again. Like, the past is the past.
Yeah.
But there are some bright spots in the future. And I think that does underlie where people do need to engage, right? Don't just count yourself out and say, it's not my time, it's not my year. because then you'll wait 5 years down the road and things are not there. There's not a lot of data that we can go off of. Again, I'm talking like, let's not get emotionally engaged. Like, okay, let's put our head in the sand and hope things get better. But there's not a lot of information out there that's saying 5 years is going to be cheaper rates and cheaper payment. But all the while, Flagstaff rents are high.
They're very high and they're not going anywhere. It's one of the reasons why you really have to stay engaged into shows like this and listening to your local market, not the national market. It's really not going to be giving you any information that's really helpful. Ask questions, talk to the right people, follow shows like this. Get the correct information so you can make a really educated and smart decision both now and for your future.
Love it. Well, everybody, that's a wrap for our first real estate rundown. Let us know, comment, share. Please subscribe and share out there. Let us know what you'd like to hear more about. Let us know what questions you have about the market. And we'll be looking forward to connecting in August. Sounds cool. And doing our next real estate rundown with you.